Welcome back to another session, guys. In this particular session, we are going to talk about fundamentals analysis. If you recall our previous session, we spoke about the types of analysis, and we spoke about there are three different types of analysis: fundamentals, technical, and sentiment analysis. The idea behind conducting the analysis is the same. All I want is to predict the future prices. I can do so in two ways. Like either I can go for technical analysis or either I can go for fundamentals analysis. There is a lot of debate going on this whether fundamentals, whether you need to be a fundamental trader like who is trading the news, or you need to be a technical trader who is deciding his positions based upon the past prices. So in this particular lecture, we are going to talk about the basics of fundamentals analysis, and I also will be sharing the top rated economic events, and like these economic events should be on your fingertips. So let's take a quick look on the session outline. So guys, first of all, we will be recalling what is market analysis, and then we will swiftly move towards a brief on the fundamentals analysis. We will speak about the quantitative and the qualitative analysis, or more properly saying, quantitative and qualitative fundamentals, and we will be speaking about like where you can find or where you can study these fundamentals on the daily basis. Then we are going to find a way to identify the market trend. Like I always say that the difference between technicals and fundamentals is the fundamentals analysis helps us in determination of the trend of the market, like whether the prices are likely to go higher or whether these are likely to fall down. And lastly, we are going to study the advanced method for experienced traders. Guys, when we speak about advanced method for experienced traders, that means that we are going to utilize our knowledge, we are going to utilize our fundamentals and the fundamental information in a way that we will not be exposing ourselves to the risk in the market. So yeah, that's pretty much it about that we are going to discuss in today's session. So let's take a look at the types of market analysis. Guys, there are three different types of market analysis: fundamentals, technicals, and the sentiment analysis. I will speak about fundamentals swiftly because we are going to have more sessions on technical and sentiments also. So speaking about the fundamentals analysis, we can say that it's simply an attempt to forecast the future prices. Like guys, isn't it pretty simple? Like all I'm that it is an attempt to forecast the future prices with the help of or based upon the related factors. What are these related factors? The economic factors, financial factors, qualitative factors, and quantitative factors. All right. So speaking about like in more detail, or we can explain it like the idea behind conducting fundamentals analysis is to predict the future prices, or to predict the or to determine the market trend. But how we are going to do so? With the help of economic events and news that is being going on in the market. So a trader must recognize the key economic reports or the political events that can often move the market. Guys, you cannot be a successful trader if you are not aware of the economic events which are going to be released today, tomorrow, or in during the week or in the upcoming month. So you have to be like we need to make sure like what's going on in the market and what is likely to happen in the upcoming week, or maybe throughout the week, or maybe what is likely to what I need to expect from the next month, from the US economy, from the Japanese economy. So I must say that the fundamental analysis is the study of like economies. Like let's suppose I am looking to invest in the US dollar. I need to make sure that I know what is happening in the US economy, what's going on with their economic side, like macroeconomic side. For example, like what are the what's the condition of geopolitical tensions? Because uh, let's suppose if I speak about the market scenario right now, the investors are facing the trade warfare between United States and China, and also the Donald Trump, which is the current president of United States, he is implementing the heavy tariff not only on the China but also on the European Union, but and as well as the Canadian and Mexican economy. So which is why like there has been a sort of uncertainty in the market. So the thing that I just spoke about, the overall scenario that I just spoke about is simply called fundamentals analysis. But if we speak about like comparatively, if I speak about the most important type of fundamental analysis, which is quantitative in nature. By the way, don't worry about it, like we are going to talk about quantitative and qualitative fundamentals in the upcoming slides. But just for the sake of quick idea, guys, the most important fundamental information comes from the central bank. So we can say that central bank has a potential to reverse the market or to set the trend of the market. I will probably we will probably have a full-fledged session on the central bank, and like how they determine the market trend, or how they can like not only determine the market trend, but also how they can change the trend of the market. Like market can reverse on the release of the information coming out from the central banks. So yeah, that's pretty much it about fundamentals analysis. Now let's talk about the quantitative and qualitative fundamentals. Guys, as it is clear from the terminology, quantitative fundamentals, the term quantitative means something in quantity, something numerical, something in figures. So the fundamentals, as you know, this is some sort of an information which can impact the market. We are clear about it. But if we speak about the quantitative fundamentals, it means that this is something in the form of figures. For example, there is a quantitative fundamental from the United States economy, and that is their labor market figures. And we try to determine the impact of these fundamentals on the US dollar. And these are like the quantitative fundamentals are most easy to be traded, because this is a quantity, and I take only milliseconds, or maybe only I require only millisecond, or anyone else in the market requires milliseconds to judge where market is likely to move based upon the unemployment rate, based upon the interest rate, manufacturing, or CPI figure. For example, if you let's suppose if I'm trading the US dollar, and I ask you very quickly that what's the unemployment rate was due to be released like in couple of minutes, and as soon as it is released, I will be like looking at the figure, and the figure was let's suppose we can say that the figure was down from 5% to 4.5%, and it requires me only milliseconds to understand that okay, this is there is a drop in the unemployment rate, and which is very good sign of a recovery in the market. So for me, this is a positive news for the US investors, for all the people who are investing in the US dollar. It is a positive news, and on this particular news, the dollar index will go bullish. So on that note, I need to enter a buy position. So guys, as you can see that like during as soon as the unemployment rate is out, I was trading the US dollar, and I will be entering a buy position really quick. These quantitative events are very very easy to to be traded, because all we have is we got the forecast. Like let's suppose US labor market was this Department of Labor was expecting a drop in the unemployment rate up to, let's suppose, 4.8, but unexpectedly or surprisingly, the figure has dropped to 4.5%, which is very very good for the US dollar. So based upon this, I will be entering a buy position on the US dollar. Then we have the interest rate figure, which is also going to impact the market. Manufacturing CPI figure, which means that let's suppose the inflation is up from 2% to 2.5%, which is good for the US dollar. So it means that I will be entering a buy position very quickly. But on the other hand, if we differentiate it with the qualitative fundamentals, let me go back, and so just to make sure that we are summing up everything. So the quantitative fundamentals are those who have a numerical value. For example, the unemployment rate, manufacturing figures, these are the most easiest indicators to be traded. On the other hand, if we speak about the qualitative fundamentals, guys, the qualitative fundamentals are something, some sort of statements, some sort of news coming out from the market, some sort of debates, discussion, press conferences, the markets, the breaking news. For example, we spoke about the latest ongoing issue regarding China and USA, like they are implementing tariff on each other, and then USA is also implementing tariff on the other economies, because the trade balance figure is very much in deficit for the United States. So Donald Trump is probably trying to overcome this thing. But this is something like whatever I spoke about is the qualitative fundamental, because it's an information. You have to access it, you have to read it or listen it, and you have to process it in your mind, and as soon as you process it, you will be taking a position afterwards. Likewise, when we speak about the press conference, let's suppose there is a press conference from the Donald Trump, and he is speaking about his upcoming meeting with the Canadian economy, or let's suppose if he is speaking about the monetary policy or the fiscal policy, and as soon as he is speaking, he will be speaking about one stuff. Okay, taxes are likely to be this, the money supply is likely to be this. So as soon as, and our economy is likely to grow or not, I'm not sure what, we are not sure what he's going to say, but he is still speaking about, at one moment he said that our economy is working, is on the growth phase, and the second moment our economy is not that good in this particular sector. So which means that market is you cannot make a decision until press conference is over, until you have all the information, and you still need time to process that information, and based upon this you will be able to determine whether dollar is likely to be bullish or this is likely to fall down. You will only know after you have processed that information. But by the time you have analyzed this information, the market should have moved half of the way, or maybe 75% of the market should have moved already. So there will be no point of entering in the market. So yeah, that's what that's how we can differentiate between the quantitative and qualitative fundamentals. Now let's speak about the most important and major economic events. Guys, I have often been asked, what are the main economic events that you need to look for in order to capture a good market movement. And my answer is always that there are only few economic events that you need to keep them on your fingertips, and these are going to be released from every economy, and all you need to remember them. You need to keep them on your fingertips, and as soon as these are released, you have to be there in front of your system, and you have to make an effort to trade them. So one of the one of the important economic event is the monetary policy decision. In the monetary policy decisions, we will speak about the monetary policy in the next lecture. That is going to be a full-fledged lecture on monetary policy, because it is very hard to cover monetary policy decision and how we can predict it, how we can trade it. In this particular session, we simply cannot do this, because this is going to take a lot of time, and we may probably miss the other factors. So there is going to be another session on monetary policy decision, how you can predict it, how you can forecast it, and how you can take position on this, and how market normally reacts. Anyways, in the monetary policy decisions, we have rate decision, we have a press conference as well. So based upon both of these events, market do moves. One of them is the quantitative, the second one of them is the qualitative. So the second most important fundamental here is the inflation CPI figure. The third most important is the manufacturing data. The fourth one is unemployment data, and there are three variants of unemployment data. The first one is unemployment rate. There is going to be unemployment claims, and there is going to be the third one, which is called employment change. So once again, guys, a monetary policy decision, inflation rate or inflation data or in CPI figures, or you can then we have the manufacturing data. You can call it a GDP figure. Then we have the unemployment data, which comes up with the three variants: unemployment rate, unemployment claims, and employment change. Alright, so having said that, guys, let's speak about the inflation, what inflation exactly is, and how we need to trade the inflation. Guys, inflation is one of the most important economic events, which is being monitored by the central banks of any economy, or which is being monitored by the government, because inflation is considered as it shows the health of the economy. Let me tell you what inflation is and how it impact the market. And guys, inflation is nothing more than a rise in the prices of goods and services. Okay, let me repeat it. So we can say that inflation is the rise in the prices of goods and services. All right, so guys, let me repeat it. This is a rise in the prices of goods and services. Now why what rise in the prices of goods and services represents? When the prices of anything are rising, what it represents that the very first thing is demand is higher. Like the demand of that particular product is higher. Okay, now what's the basic reason behind the rise in the demand? That can be people have more money, like the money supply is high. Okay, now why people have more money? That's probably the basic reason can be, or the root cause can be, people do have jobs. Okay, why people do have jobs? That is because the corporate sector is working fine. Okay, now why corporate sector is working fine? Because there is more demand of the products. Probably there are more orders, so everything is good. So it means that they need to produce more. When they need to produce more, they will be hiking the GDP. The GDP is the manufacturing activity. So in this way, that is why inflation is basically one of the economic events which is interrelated with the other economic events, and the rise in inflation is considered good for economy. For example, the higher inflation, it simply represents that investors have money. So not only the investors but general public have money. They are going to increase the demand for products, and as soon as they increase the demand for the product, the prices will go higher, and the rise in the prices of goods and services is called inflation. And guys, the higher figure is considered good for economy, like the rise in inflation is considered good for economy. And then, for example, on the other hand, there is a low inflation or deflation. Okay, deflation is exactly opposite of inflation thing, or low inflation is exactly, definitely it is, I don't have to say it, but inflation is like the opposite of inflation is deflation, and deflation is the low drop in inflation, which means that investors are not this is the first of all we can define it as it's a gradual decrease in the prices of goods and services. And it means that if the cost of certain product is $1,000 or $100, I'm selling it for $80 because no one is here to buying it, and even though people are not appearing to buy it. So probably the reason is people do not have money, and they, or maybe that's because they do not have jobs. So it is representing the worst scenario of the economy. Like if I am not living in the United States and I am monitoring the inflation rate of the United States, definitely I will be curious, I will be cautious about my investments, and I will never be investing in the US dollar if the economy is not doing well, if the inflation rate is dropping down, or you can say that if there is a deflationary risk to the economy. Which means that sooner or later the economy is likely to collapse, and in order to help the US economy, central banks will play with their monetary policy. They will probably lower the interest rates. They will probably increase the supply of money, which is definitely not a good sign, which is definitely not a good thing for the US dollar, because a rising increase of supply results in a drop in the prices. So that's what we can say, like if central bank decides to increase the money supply in economy in order to accommodate their corporate sector, this is going to cause a drop in the exchange rate of the US dollar. So which one is better, like deflation is better or inflation is better, guys? The definitely inflation is better, but there is still targets, like the higher inflation, the inflation above the targets of any government is likely to become a hyperinflation. The hyperinflation is also not a good sign for the healthy economy, because this is going to cause a sort of a monopoly scenario in the market, and this can also hurt the economic situation of the market. However, economists decide, they do set a benchmark, like let's suppose for the United States and for the Eurozone, the benchmark is 2%, and as soon as the like both of the economies achieves 2%, they will start adjusting their monetary policy statement in order to ensure that they are not going to hurt the market. So they are keeping the balance in the market. Guys, on the economic events side, you will find inflation figure, like it is called consumer price index. This is a CPI figure, and the CPI figure represents the inflation. So it has a medium to high impact on the trading instruments. For example, if the CPI figure is coming out from the United States, it normally causes like 50 to more than 50 pips. Like if there is a divergence in the CPI figure, this can often cause more than 50 pips movement in the market. And based upon this CPI figure, the central banks do decide their upcoming interest rate. Comparatively, like guys, there are two figures which are released. One is CPI, the second one is core CPI, which is core consumer price index. In the core price index CPI figure, we do not include the food and energy prices, because this is one of the most volatile sector of any economy. So in order to have a look on the true picture of the economy, we look at this core CPI figure, and core CPI figure do moves the market a lot. So moving on towards the labor market figures, guys, there are three different types of labor market figures. The first one is unemployment rate, which is a monthly figure. Then we have non-farm payroll, and which is also monthly figure. And then we have jobless claims or unemployment claims, which is a weekly figure. Weekly figures mean it releases after every 1 week, and the unemployment rate and NFP are released only once a month, after every month. Like the NFP figure is or let me say that the NFP and unemployment rate is one of the most highly awaited economic events, and these are released on the first Friday of every month. So once again, the non-farm payroll is, guys, one of the most high impacted economic event, and investors do like wait for this economic event for whole month. And most of the time there is more than 100 pips fluctuation in the market. The non-farm payroll do change the direction of the market as well. So for your information, all you need to do is, you need to keep in mind that on the first Friday of every new month, the US labor market, the US Labor Department will be releasing the figures on the labor market report, and that will be NFP, and that will be unemployment rate. So for your information, guys, the initial jobless claims represents the amount of claims that has been filed by unemployed people, saying that they are unemployed and they do not have money to spend. So this is a weekly figure, and this has this is not that much high impacted economic events, and most of the time, like if there is no divergence, the investors ignore this figure, because this is mostly overshadowed by the actual unemployment rate and non-farm payroll. Anyways, guys, before I proceed further, let me give you a really quick idea about how we can trade the unemployment rate and non-farm payroll. They both are released at the same time, at the same on the same day. So let's suppose if unemployment rate and NFP both are positive, we can simply buy US dollar. But on the other hand, let's suppose that if the unemployment rate and the non-farm payroll is negative, I like both are suggesting selling in the US dollar, so I will be looking for selling the US dollar. However, the problem arises, or the point of concern is, what happens if one figure is positive and the second one is negative? What you are likely to do in this particular scenario, guys? Most of the time I like to stay out of the market. However, if I believe that the non-farm payroll is very much different from unemployment rate, let's suppose, is down from 3.8% to 3.9%, but the non-farm payroll is up from 90K to 350K, which means that is coming with a huge divergence, right? So we can say that this is positive. Okay, so no, I have to like schedule it in this way, that the unemployment rate is bad from 3.9% to 4%, and we can consider it is negative data, and this is positive. So which means that the non-farm payroll is heavily strong, like it is incredibly stronger than before. So guys, this is how market is likely to move. The investors do price in the non-farm payroll at first, and then market starts moving on the labor market figures, right? So if one data is positive, one is negative, all you need to capture a spike or a dip on the non-farm payroll first of all, and then because these are released on Friday, then during the maybe during the late US hours, market will start moving on the unemployment rate. But more properly saying, on the coming week, on Monday, market will start pricing in, or market will start settling itself on the on the basis of unemployment rate, which is positive or negative, it really doesn't matter, but market will start moving on the unemployment rate. All right. So speaking about the another economic event, which is called the GDP. Guys, GDP is the gross domestic product. Let's speak about what GDP is. It's a value of goods and services which are being produced in the territory of an economy in 1 year. Let me repeat myself. The GDP represents the value of goods and services that are being produced in the boundaries of one country in 1 year. Right? So if the GDP growth rate was higher, if the figure of GDP was higher than before, which means that in this particular year the US economy has improved itself, there has been more productivity. Definitely when they produce more, they will be selling more. When they are selling more, their profit margins will be high, and they will be paying more dividends, they will be attracting more investors, and they will be improving their labor market figures, they will be improving their inflation conditions. So GDP is considered like one of the most important economic events, just like CPI figure and the interest rates. So guys, how it works, there is a impact of this. This is how it impact the currency. Higher than, if the GDP figure is higher than forecast, it strengthens the currency. It means that if the GDP was expected to be like 3.5%, but it actually came out as 4%, I will be looking for the buying position in the US dollar. Which means that its economy is healthy, or it's a pro currency, and the central bank is less inclined to lower the interest rate. On the other hand, the lower than forecast figure weakens the currency, which means that based upon a drop in the GDP figure, I will be expecting that no, the US economy is not working well, so I will rather look for investing my money in any other economy. So I will be withdrawing my investment from the US dollar, and I will be moving it to the other currency pairs. Probably we have euro, we have like so many currency pairs I don't have to mention, right? So the lower than a forecast GDP is likely to weaken the currency, and this is the economy is not held as healthy, and central bank may be more inclined to lower the interest rate. It is anti-currency. So this is how we can trade the GDP data. And lastly, we have trade balance figure, which is also very important from trading point of view, but not for all the economies, guys. This trade balance figure is important for only to those economies who are export oriented, because the trade balance is a difference between export and imports. Like, let's suppose if we speak about the Canadian economy or Australian economy, they are export oriented economies, just like the China and Japan also. And if their exports are higher than their imports, which means that they are selling more than they are buying, which means that the greater exports and lower imports represents the trade surplus, which is positive for which is good sign for the currency. On the other hand, if the imports are greater than exports, this is called a trade deficit, and a trade deficit places a negative impact on the currency. It is also called negative trade balance. The surplus is called the positive trade balance. So yeah, this is how we need to trade it. Like for in case of the main economies who are famous for their exports, if their trade balance shows the trade surplus, I will be looking to invest in that particular currency. However, if it is showing like trade deficit, I will not be interested in investing in that particular currency. Now let's speak about where you can find these news, guys. The very first resource that I personally use is the Reuters. It's a news agency, and they always keep you updated about the latest news. There is a Wall Street Journal and Bloomberg, MarketWatch.com. And if we speak about the economic events, or the quantitative and qualitative both, like if you want to see like what is going to happen today in the market throughout the day, or tomorrow, or day after tomorrow, or in the next month, you only need to visit you can visit the forexfactory.com. And here you will be finding all the economic events which are due to release with the forecast, as well as on the time will also be mentioned. So guys, but yeah, that's pretty much it for now. And thank you so much for joining us, and see you again in the next session.